welcome back to Wealth Mavericks, the only show where we talk about the secrets the wealthy know and the government won't tell you. And on today's episode, we're talking about real estate as an asset class, and we're going to discuss the pros and the cons, especially tax advantages.
Stages of an asset, the contribution, the beginning, the accumulation, the where it grows, and the distribution where you start taking income out. And every asset has these three stages. It's not just the asset, it's the overall plan. When we look at sports, when we look at business, it's not just the one person and what they're supposed to be doing. It's what the entire unit is supposed to be doing.
So, Bob, I know there's a lot to talk to people about when it comes to real estate. I know you have a lot of not only experience, but we've got multiple funds that we have dealing with real estate. So your knowledge, I think, in this area is really important. As we dive in, what are your thoughts, just generally speaking, highest level, 50,000 foot view of real estate as an investment class? What are your thoughts?
I think it's a good asset class for people to be into, but I don't think it's the only. And I would say that about every asset class. I'm not talking about diversification and allocation like traditional investing is talking about. I'm talking about understanding a game plan for you as an individual investor or an individual person, and what you're looking for the outcome of your holistic wealth plan. Right.
And it's one of those areas, real estate, I've found is one of those areas where real estate people tend to be really real estate heavy. It's like they are not diversified in it. They're all in on real estate and everything else is scary, or other people where it's like, I'm just not comfortable with real estate. I want to stick with the stock market or what it feels like it's this world that lives on its own. And so I think it's an interesting topic for us to explore today.
Well, and here's the thing is that we always hear about real estate being such a tax efficient asset, and it actually is. And so is your business. Mm-hmm. But guess who comes to us for tax advice because they got profit and they're paying a lot in taxes? Not just business owners, but real estate investors. Mm-hmm. So even it is traditionally the mindset is it's so tax efficient. We can talk about some high level stuff today in this episode of probably why is that? What's kind of the main focus that a lot of them are using, and over a period of time, it's longevity. Right? It's a longevity of an asset. And again, we talked about the three stages of an asset, the contribution, the beginning, the accumulation, the where it grows, and the distribution where you start taking income out. And every asset has these three stages, and it depends on the length and of course how the IRS is going to tax different aspects of it. Okay. Mm-hmm. But when it comes to real estate, it's really interesting because it's like business. Oh, you're a business owner. Oh, okay. But does that say what you do? Right? What is your business? What do you do in your business? Right? Oh, well, I'm you could say that I'm in real estate. Well, what kind of real estate? Are you a broker? Are you an investor? Are you a manager? Are you a lender? Right? It's such a big initial term that no one knows what that really means until you start diving into it. And so the word real estate is just that.
So, I think in the episode today, what I want to talk about is one, helping people understand if real estate is a good investment for them. Mm-hmm. If so, what kind of real estate? We've talked, ad nauseum about this. There's so many, there's not only different classes, but subclasses of real estate. Mm-hmm. So I think that's kind of where I'd love for our listeners to be able to walk away today going, is real estate a good investment for me? And if so, what kind is the right kind? So, who would you say from a high level, who is real estate right for, mm-hmm. For investing?
Mm-hmm. Well, I think it's right for everybody. But there are certain criterias, and I think the criterias are, again, I hate to keep saying this, is the outcome of what your plan looks like. So if somebody wants to, I joke, wants to wear a tool belt, well, then they're probably a flipper, right? They're probably, they like to do maintenance, but how long do they want to do that? right? They may like it now, but if they have 15 houses, do they want to do that? If they have 20 houses, do they want to do that? Are they just going to keep the two and it's just a hobby where they just like to put on a tool belt and do it every once in a while, right? What are they looking for? Or if there's somebody that says, man, I don't even know how to spell tool belt. I think I saw a Home Depot commercial that talked about it. I don't know, right? Then that person isn't going to want to be single family home. Probably they're probably not going to want to be a flipper, right? They're probably going to want to be in something that here's my investment, and my investment's going to do X, Y, and Z, and just report to me. They want to be very passive, right? And the IRS actually has guidelines for these types of investors, active and passive. Right. And understanding what an active and passive investor is, being profit and loss. So if you're a passive investor, you're not going to necessarily benefit from losses per se, unless you structure your plan accordingly to where you can take some losses as a passive. Okay.
So what does that mean? Active and passive. What does that mean from an IRS perspective? How would I know what I am?
If you're investing in real estate and you're actually doing real estate, meaning you're a broker, or you're actively looking for properties, you're buying, selling, you're negotiating the deals, you're getting lenders, right? That is your full-time job. That is what you do. That's who you are. I have a business card that says I'm a real estate professional. That's active.
Okay, right? So that's going to be active income from the real estate profession.
Correct. Okay. Now, it's not active income in the sense that, okay, I am a doctor, and I'm doctoring and I earn income, and I'm active in real estate and I make income from real estate. Doesn't make you a real estate professional, and doesn't make you active in it, even if you're making more money in real estate than doctoring.
So is it kind of like the IRS is looking at you and going, what's the real deal here? Like, what's your job? Like if your job is, something other than real estate or flipping homes or whatever it might be, on the weekends and the evenings, you're swinging hammers and plumbing and doing all. It's like that's not your job.
Yeah.
And so they're trying to make a determination about how do we want to treat this person.
Yeah, no, absolutely. And you got to think about it from this way. If the IRS is going to give you something, there's going to be some criteria to it. Okay. And so there's a lot of tax benefits to it. And typically there's changes into definitions, because just like there's rules, because there's usually lawsuits. Right. So when it comes to the IRS, is that if there's certain guidelines and steps to doing certain things, criteria to doing certain things, it's probably because people took advantage of something. Okay. So let's use doctoring as an example. I'm doctoring, I'm making $500,000 a year, and I buy a bunch of real estate, and I take losses from my real estate and offset all of my taxable income, and I don't pay any taxes. Well, at some point the IRS is going to say, hang on, you're not really real estating, you're doctoring. But if there's enough people doing that, the IRS is going to look at the balance sheet, they round to the nearest million, and if it starts affecting that rounding to the nearest million, they're going to start making some changes. And rightly so, right? The people call them loopholes. There's no loopholes. There are rules. You follow the rules. The IRS had rules. People followed the rules. The IRS said, oh, that's not what we meant. We're going to change the rules. Okay. It's not a loophole. Right. We like to use these terms like we're taking it. It's like when you buy a car. You always drive off the lot, and what do you tell all your friends? Oh, I negotiated them all the way down. I got a great deal. The heck you did. It's like Vegas doesn't have $1 billion resort because people make money.
Right.
Right. They're not selling cars because they're losing on deals. Right. They're always making money somewhere. So, but we feel good. They made us feel good about it. So anyway, so on the real estate side, there's multiple areas that we want to look at. Okay. And so we got the active and passive. It doesn't matter which one you are. What matters is what you want as an outcome. And that can dictate in how we structure that. So should we talk about the different types of real estate, or how do you want to take this?
Yeah, I think that's so. One, I think that's an interesting perspective. It's like, who is it right for? It's probably right for everybody, depending on what their involvement and the type of real estate. So yeah, let's talk about the types of real estate that exist. I know we don't need to get super granular, but there's categories and subcategories and pros and cons to all of them. So what do you see as the highest level? What are the classifications of real estate?
Yeah. So the least barrier to entry is residential, right? So single family homes. And if you go into single family homes, most people get a mortgage, right? They borrow money. And so the way the mortgage structures work is that you could have a single dwelling. So a one unit, one household, one doors, single family home up to a fourplex. So single family home, duplex, triplex, fourplex. Those are all considered a residential loan. Okay. Which means that to try to qualify, it's going to be based on your income. They're probably not going to use the income from those properties as qualification for that particular loan.
So for 1 to 4 units, it's basically like your income, your personal income is going to support that asset being built.
Correct. And I'm not saying that's bad or that's good. I'm just saying that's what it is, right? Your situation and what you want to have an outcome and accomplish in your plan will dictate, is that good or is that bad? Right. So then you have that. Then you have multifamily. Okay. Multifamily is 5 units or more. Typically, multifamily for the majority of us are large apartment complexes where they're, 30, 40 plus units. Okay. Now there's some areas where you go to, like in California. I grew up in California. There's some areas where you'll drive around and there's 7-unit apartment complex. Well, that was vacant space. Somebody bought that land and built 7 units because that's what could fit on that. Right. And so there's 15 units. But right now, today, if you were to go look at new construction of multifamily, they're like 200-300 unit places, right? They're multi-uses. They're 4 or 5 stories high. Or they're going to be high-rise apartments, right? It's no longer we're going to build out 7 units because it's a return on investment.
That's interesting because so in the area that I live in, they're trying to rezone literally our neighborhood to allow for up to 6 units on a property. And now that I'm thinking about this, I think that's an interesting play. And I don't know exactly what that's going to do long term for the prices of this area, but like parking, 0 chance that's going to work out here. So you're going to create some crazy problems. But I could also see people who perhaps live here right now and they're like, hey, I'm going to scrape this and I'm going to build a 6-unit, something or other. And then all of a sudden I've got, income coming from those 6 units. I don't care about the value, long-term necessarily. It's like, I'm just going to get what I need to from this. So, even in those little pockets of areas, but it's not the majority of the unit that you're talking about. Like the majority they're looking at as an investment and they're like, hey, we're going to maximize our, whatever we can from this property.
And in some areas, like in parts of California, I have a friend who is a architect for multifamily complexes. And he came to me and said, hey, Bob, do you know that California and certain areas have what they call, I don't know the exact term, but it's like bonus units. Meaning that if you have a particular property size, lot size, it zoned or could be zoned for, let's say, 8 units. But because the housing demand is so great that they'll give you the opportunity to go from 8 units to 12 units if you reach certain criteria. And what do they take away? The parking. They allow you to actually turn it into an 8 unit, and they'll waive kind of all the demands of what a normal 12 unit would be, because it's normally an 8 and there's a bonus. So there's certain areas that are doing that. And we looked at going to buy half acre lots that are in the metropolitan Southern California area, because there's a lot of land, just like little lots, corner lots, just sitting there. It's somebody who owned it. They had a shop, it burned down or whatever, or they passed away. It's sitting in a trust and it's just sitting there vacant. Right. And so we talked about doing that because it doesn't cost a lot. The person who makes the most money really is the developer. So we got an architect, he designs it. We get some money, we build it and done. And then you can flip it or you can keep it as income. But again, what's your outcome? What do you want to do? So there's multifamily, and then you have commercial. Commercial could be considered multifamily, could be considered office buildings, different levels, A, B, C, meaning A being high rise, right? High end, B meaning C being on the lower end, and B obviously in the middle. Housing, you have HUD housing, meaning low income housing that the government subsidizes some of that. So that's not going to be an A, B, or C. It's going to be its own category, right? Now you look at office buildings, it's going to be different. right? In some of the older areas, you're going to have, some office warehouse spaces where you'll have maybe a 200 square foot office, and then you have a bay door that goes up and it's a warehouse, right? And the total size is 1,200 square feet. So you have 1,000 warehouse, and this is very popular in California. Right. So that's where your plumbers, HVAC guys go. That's where your small business artisan contractors go. Right.
Mm-hmm.
And then, of course, you have your industrial. Then that could actually be considered industrial as well. Then you have your industrial where you have your big tilt up cement buildings. You have your warehouses. You have manufacturing. Industrial would also include probably restaurants, that sort of stuff. So and what do you want to do? Do you want to own land on a restaurant? So we have friends that my son went to high school with. His dad owns land, develops the land for chains. So he has 3 or 4 properties in California and Orange County where he has Starbucks on it. Well, they all sign 10, 15, 20-year leases. So he owns the land and he's getting rent from Starbucks.
Right.
What's the likelihood of them shutting down? Right. So that's smart. So McDonald's, a lot of people say McDonald's is a restaurant franchise. No, it's a real estate company. McDonald's owns all the real estate underneath those units.
Mm-hmm.
It's a real estate company. They own more real estate than the United Postal Service.
Right. Aren't they one of the largest real estate holders in the world? I understand.
Yes.
Right. But again, I think the philosophy of begin with the end in mind, knowing when it comes to real estate investing, it's as with any kind of investing or even business development, it's, when you start the thing, that's where your money is made. How you buy it is going to determine a lot of things. So begin with the end in mind when you're thinking through that. So there's single family residential, there's commercial with a lot of different classifications, multifamily, office. We've talked about this before, parking, public storage, mobile home parks could fall into this, RV parks, like a lot of different things. And I think maybe this is part of it, like with our listeners, they may be thinking, maybe I'm not ready to invest in real estate because I don't have $1 million to go buy, whatever it might be. I have a friend who I've been following for years on social media, and he has been kind of this strategy of cabins. And he's like, cabins could be a yurt that he puts up near he likes to do this near national parks. So people going and visiting national parks, it's very difficult to get lodging in those. So he buys these like small, like $30,000 plot of land. It's basically raw land that he'll then put a yurt on and then do a Airbnb. And he's generating. So I think we can get more creative than just what maybe our grandparents did. And say, okay, how are we going to approach this, in a way that's conducive for me and inside of my plan?
Yeah. And that goes to what you just said, inside of my plan. It's understanding what you want, build a plan, execute the plan. Mm-hmm. Right. And that's, I think that's the biggest thing. So real estate is different for everybody. Now, your friend is actively involved. This is something he thought of, makes a lot of sense. Let's go do it. And he's going to be actively involved with it. We're going to have a lot of people that, they have full-time business or they have a full-time job. And they're like, you know what? I just want to do something with my money and I don't know what to do it. I don't want to put it in the stock market. What else do I have? And I don't know real estate. What else is there? Mm-hmm. And this is what we'll do is we'll sit with people, go through the existing assets they have, develop their understanding of what their plan is, and then say, okay, what kind of real estate? Well, how do we get into real estate? Just because you're getting into real estate doesn't mean you have to have millions of dollars. You can get in for less than that. And depending on what your goal is and how you want to enter, dictates what, to your point, your exit. Okay. Mm-hmm. Got to get started though. Right. And so understanding what that looks like. And why do I want this particular asset class? Real estate, they're not making more dirt. Right? Now, we are putting more things on dirt. Mm-hmm. Right? And so we've, in California, become very creative of turning hills into neighborhoods, mountains into neighborhoods, right? Mm-hmm. There's an expense to that. Here in Texas, you're just moving dirt. You're making sure it's all level versus having little molehill bumps. Right. But, they're putting stuff on it.
How do you see? So one of the thoughts that I've had for years as transportation becomes easier, faster, more accessible, things like automated self-driving cars, that changes a person's commute. So, cities in the past, they're building them up, and I'm seeing a trend that seems more like they're building them out, because it's, less density, per square foot, per square mile, whatever you want to look at. Even things like flying cars, they just, I think they released for commercial use the first flying vehicle. I mean, that's crazy to me. I mean, I can't imagine that. Like, my car breaks down, I just pull over to the side of the road. When the flying car breaks down, that's a whole different story. But if all of a sudden 100-mile commute is not an issue with a self-flying vehicle that gets you somewhere, like where do you think this is going to go in the future when you're looking at like large development that way?
That brings up a phenomenal topic in question. Industries competing with each other. Industries that are competing with each other. Think about it. Self-flying cars aren't going to happen in downtown New York. I mean, there's such a dense population, right? It's like the future movies where they all have these lanes and stuff, right? They're all zoom in. Imagine how that's going to work in the next 10 years.
Not in the next 10 years,
right? Exactly.
But in the next 100 years, maybe.
Maybe if we're still around here, yeah. Right. Mm-hmm. But that's the point, is that, so where's this industry of developing these flying cars, and who's the first people who are going to want these? Not people in the suburbs, people in the city. So if people want these things to work, they're going to have to leave the city. They're going to have to be put in a position to where they can leave a city, get a flying car, because that's the industry. That's something that they're demanding and they want to be a part of. Okay. Mm-hmm. Real estate is all of it. Right. So I think this competing of industry is what's going to dictate real estate and living and housing. You have people that are talking about building towns and communities where it's all self-sufficient.
Right.
Well, then you're not talking about the density of downtowns. Now, politically, you can say that there's a certain political focus on keeping people dense in a downtown, squinching more people. And when you look at the political map, the entire United States is red, except for where all major city is, and those are blue. But that's where the majority of the people are. Right. So you can make the argument that, is that the plan? Well, then who's building these high-rise apartments? The money that's backing that plan. Right. If you're looking at the spread and the sprawl, right, the people who want to have a family, the people that want to do certain things and have a dog and walk dogs and nice walking trails, that kind of stuff, they're not going to be city people. They're going to be suburb people. Right. And there's industry for both. And so when you go to suburbs, you've been to my house. I could probably go to your house, and we can go right down the same street. And we're going to see all the same types of shops along the road. Mm-hmm. Those are industries that are competing for you and our dollars. Mm-hmm. It's all real estate. Right. Who's going to win out? I don't know if there's going to be a winner. I don't know.
Right. Well, it's to be determined, where that's going to go. Because you do have, different, competing, like you said, competing industries, competing thoughts about how humans should develop in society. Mm-hmm. So, we've all heard of like the 15-minute cities. It's like everything that you need is within 15 minutes. Well, that's going to create a lot of population density, and then you've got different issues to deal with. What would you, and this is a totally separate topic or different topic, when it comes to real estate and the people that you've dealt with, who would you say are like the biggest winners when it's come to real estate? It's like, hey, they've crushed it with real estate. What does that look like? How did it start for them, and what did it turn into?
People who have the expectation, they want their wealth, they want their money to accumulate. They're not focused on the current trend of, I'm going to get you an 8% rate of return. My fees are 1.5%. That is traditional stock market investing and traditional advisory conversation. I'm not saying that that's bad. You're asking me a question that I'm answering to, is that the people that don't allow that squirrel, don't allow that shining object to deflect them and saying, I have this money, Bob, Joe, and I just want it to grow. Mm-hmm. Great. let's put it here. They don't have an expectation that tomorrow, if it's not doing what it should be doing, I'm taking the money out.
Right.
That's not reality. That's not how life is. Right? It's not how we raise kids. That's not how we live our own life. Right. But all of a sudden we feel like we have to do this because this is how we're being bombarded and trained and brainwashed. Right. Mm-hmm. But the people who are like, I like that idea. It's part of this plan here. Here's the time frame. Here's the potential expectation. Here's how you're designing it. I could get some tax benefits, so it's going to yield my tax benefit here. So I'll keep a little more cash. So that's part of my rate of return as well. And this gets to appreciate. And down the road, it really should be more than what it was ahead of inflation.
Because they're not making more dirt.
That's right.
It's like, it's. And I've seen that same thing. I have some, friends, very, very close people who their grandfather purchased a chunk of land in San Jose and held on to it for a long time. And, part of it was, eminent domain, like was needed to be used because it was so much land. Government had to buy some of it back for infrastructure. And they held it for a very, very long time. They used it as an asset in the meantime, but exiting that property became very, very difficult. It was, and I don't know, honestly, I don't know that there was a financial plan in place. It was just for them at that moment, it was the right move to do this thing and then turn it into what it became. They made a lot of money on that, or, their heirs made a lot of money on that, but it was a difficult process. So when it comes to like, your typical person or the average person that's listening to this podcast, what should they be thinking about? Like when we say begin with the end in mind, or, the money's made when you sell it, not when you buy it. What does that mean for the average listener out here?
Well, I think, there's multiple things for, again, this is our podcast. This is our YouTube. This is our opinion. It's not just the asset. It's the overall plan, right? When we look at sports, when we look at business, it's not just the one person and what they're supposed to be doing. It's what the entire unit is supposed to be doing. For some reason, we have created this mindset that our asset is supposed to be the main thing that's doing everything. And that could be because of the banking investment system. Go back to financial distributors episode. And what they're focused on is making money. And so they're going to focus on making money by having you and I think that we have to do a certain thing. So when you put money into a retirement account, where does it go? It goes to mutual funds, right? And then the conversation is rate of return. Then the conversation was fees. And the conversation was, set it and leave it and don't even think about it, right? When it comes to what we're talking about, it needs to be part of an overall plan. And is it not just the appreciation, but is there a tax benefit? Is there an access to capital? How do I use this asset to create more assets? Mm-hmm. That's the key that I've learned so much from Warren Buffett is that you can buy a business, you can buy an asset or invest in an asset, but what are you going to do with the capital that it creates? You're going to go buy a boat? Or are you going to take that and go buy another asset and then buy a boat? Because now you have two assets, right? Mm-hmm. And you have some discretionary and you can reward yourself and all whatever. But that's the key. It's an overall plan. And I think we put unfairly, we put too much expectation on a singular part of the plan and expect a certain result. And if something happens economically and it doesn't do it, then all of a sudden it's a bad idea. No. Just that's the part of the plan, is that there are going to be things that happen and we need to have that understanding of that expectation. That's why I said earlier, it's about diversification, allocation, not in the traditional stocks, bonds, mutual funds, but understanding your assets of how they're going to work with each other to create an overall outcome that is what we're looking for as an outcome.
Right. What would you say, for someone who's considering real estate as an investment, what's the best way for them to get started? Like what's a traditional, not necessarily traditional, what would you say is the best pathway for them to take? They've determined, yes, real estate's right for me. I want a, longer term, holding. How do they get started?
I think the first thing is be passive. meaning don't try to be active. Don't try to go out and look for real estate and try to build this real estate empire on your own, because you got to learn stuff. And if you don't learn stuff, or you're learning stuff and then you're making mistakes and you're learning from those mistakes, there's a cost to that, right? And it's not just a dollar cost, it's a time cost. And I'm not saying that's a bad thing. I'm just saying most people aren't going to have the determination to do that. But you can get the same learning experience by being passive and spending time learning why things are being done. But you're doing it without having that time and money risk, but you're allowing professionals do it. You get to be passive and learn how the flow of the cash works in that particular asset and how that means to you, to where now you can say, oh, so if I did this actively, here's what I need to focus on. And here may be some other things and criteria that I need to worry about as well. But you've taken a lot of that heavy lifting or that experience because you've learned it through passive, and you won't need necessarily have to make those mistakes that you would learn from passive. That would be my initial, because you can control the amount of money you put into it. And you can always add to the passive as well. And if you find that that's the pathway you like, and you're like, hey, this fits me. I thought I wanted to be active. Now you don't have to exit active, right? But it's easy to exit passive because there's always people who want to be passive. That's how they're structured. And if you want to exit passive, you can to be active. But it's time and expensive to exit active to get into passive. So it just makes sense to go passive first.
So what is that? I mean, again, for your typical person, they don't even know what you mean when you say active versus passive. So I've got $50,000 and, I don't have enough to go buy a plot of land or whatever it might be. So what when you say go passive, what does that mean?
So work with somebody like ourselves where we have a fund and we have a particular specific, we have two funds that we're very particular and specific about. And maybe it's not necessarily about that 50,000. Maybe it's I have 50,000. How do I get this 50,000 to be something more, to where I can put more into real estate? Well, we have other opportunities from that aspect as well. But the key is I have 50. Here's what I want to do. And then we can create in part of your plan, say, here's why I like this particular fund. It does all this stuff. And we can look at all these criteria and kind of have all these conversations. And you can say, oh, I like that. Right? You didn't have to go out and look for it yourself. You didn't have to go spend time, energy, money, hire people and all this kind of stuff. It's part of the overall plan. If you decide, I don't know if I like that, I was kind of thinking this. Awesome. That's the point of that whole process, is figuring out what you wanted. That doesn't sound like it. How about this over here? Right? And start having that dialogue and conversations, not just throwing the 50 grand at something. And who knows, in this process, I've always found that when people understand a particular asset, they all of a sudden no longer have 50 grand. They always have more.
It's when they understand it, right?
That's right.
So when you're saying passive, there's a lot of different ways to do that, but one way is a real estate fund. And then what are they looking for? Like what are they learning through that passive investment? Is it, hey, I'm studying the financials, I'm studying the documents that are supporting all of this? What is that? What would they learn by being passive to know if they want to do more of this?
Yeah, all of that. I'm learning the financials. I'm learning how the cash flows. In our particular fund, my partner does quarterly webinars and gives updates on how things are going. And he has other funds as well. So it's not necessarily our fund. We can go look at his other funds and learn from their communications. Part of the process of being a member, it's part of the process of being an investor in the fund, is member first, investor in the fund, and then have access to all this other data and information. And then they go through their methodology. Here's what we're doing. Here's why we're doing what we're doing. Here's the cost to it. Here's the benefit to it. And you all of a sudden start learning specifically, and it also starts bringing up some questions in your mind of what else you want to learn. Right. And then that can dictate your next pathway of the education and learning process. That's where the passive really becomes powerful, is that it gives you enough information to start generating questions where right in the beginning, you're like, I don't even know what to ask.
Yeah, I'm completely well, it's really interesting. Same thing happens when you invest in companies and you get to be part of meetings that you wouldn't otherwise be part of. You learn that business, and that would apply to other businesses in the same way. So I think it's really interesting to look at it this way from a real estate perspective. If you are interested in investing, find a fund that you believe in, understand the methodology behind it or their philosophy, I guess, and then pay attention to everything that's going on if you're interested in exploring real estate, as an asset class for you.
Correct. Yeah. And this is an interesting area of conversation because it's going to cause somebody to understand what model they're interested in. You've heard me say this before, and is you need to like the business model, because the model is what gives you the why you're doing something, and then what the business is or the types of businesses outside of that or that are part of that model, but they're more cosmetic. Right. It's like when people in construction or do the HGTV and they're going to remodel, and they're like, oh, this house has got good bones. Right. You got to find a model. You got to find good bones. Right. The rest of it is whatever that business or whatever that service or product is, or the type of real estate. But you got to find the model. You got to find the good bones and what you want to do. Because that when there's issues, there will always be issues. You become less emotionally affected by the issues because the model is what you chose. It's just the issue. Right. I don't like that paint. It's a lot brighter than I thought on the little Schwab. We got to redo this whole thing and let's do it.
Right.
Right. And it's not like, oh, this house sucks. The paint is too bright and you sell the house. Right. No.
Right. Right. You repaint it. You don't rebuild the house.
Yeah.
That's a good point. That's good. Well, I hope this has been helpful for everybody. I know there's a lot that we've covered, and I'm sure people have other questions. So, make sure to reach out to us, connect with us on social media, leave a comment. Let us know what your questions are for real estate. So, and make sure to join us on our next episode where we're going to talk about the most important questions to ask your CPA to find out if you've outgrown them. So we're excited about that one. So thanks for joining us on Wealth Mavericks today. If you want to be part of the conversation, join us over on our LinkedIn, Facebook pages. Leave a comment. Let us know what you thought. More importantly, what questions you have.